Hey folks, welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. Today, Wednesday, January 20th, 2010. Well, a massive drop on Wall Street again across the board as we're seeing stocks sell off. The Dow is down 160 points, 1.5%. The Nasdaq is down 39 points or 1.7%, while the S&P 500 is down 16 points or 1.4%. Now, the key here is this, folks. As you can see on the chart of the SPY intraday, we are off the lows right here. Here's the low of the day. Happens to coincide right with our key master channel trend line at 113 to 113.20. And you can see we've risen off of that nicely. In fact, making a little bit of an in spirit of bull flag pattern into the light volume afternoon period. Volume today overall is very heavy compared to what we're used to seeing in January of 2010. However, you can see definitely the volume has started to lighten up. And when volume lightens up, we know it generally favors the upside. So again, to see a sideways float into the close today, maybe with a little more upside bias, is not a shock to anyone out there that trades this market. Bottom line, what caused this drop? Let's talk some angles here. Number one, we have earnings. IBM came out with earnings. Now, the earnings were not bad on IBM, but clear as a bell, it was just overbought, priced in. They had to literally blow out earnings by 50 cents or $1 to continue to rise. They blew out earnings by a decent amount, but not by nearly enough to warrant the price to continue to move up. With that, the stock price is selling off. I talked a little bit about this to my premium subscribers yesterday before the earnings came out in the chat room in the research center, and I said, guys, I'd give it a 65 to 70% chance of a fall on earnings. Sure enough, IBM down about $4.50 today. Now, the key was to look at the daily chart. Now, this daily chart was almost identical to Intel's before Intel reported earnings. Why? Well, because you had a double top that had been broken to the upside prior to earnings. For instance, this is exactly what the Intel chart looked like going into this day. So here's your double top right here. You pushed up into it and you closed above it. The amateurs out there are going to look at that and say, wow, that looks like a breakout. I'm going to jump long. The pros like me at In The Money Stocks, as a chief market strategist, as understanding the methodology that we work with here, is going to say to you, look at this, it broke above it, but you don't have a confirmation candle. Remember, confirmation in the money stock signal means a secondary close above that high of this current candle, and going into earnings, obviously you did not get that. Therefore, I would tell you to either wait on the sidelines or go short that play. Sure enough, paying huge dividends here on a drop today. So you can see how the amateurs always get the money taken from them. If you're an amateur out there, you know the feeling. All right, and again, it's important to step up to the plate and start learning the rules to trade by. And again, that's what we strive to teach you in the research center, in the chat room, you name it. We're teaching everyone out there that comes to us how to maneuver through this market and not get caught off guard on these plays, or be the right side of the trade so you're making the money, not the institutions and the pros. All right, so again, there's your move on IBM yesterday into earnings. Notice how it took it out. The amateurs say, oh, that looks like a breakout. I, as a pro, say not so fast, and look at the drop you get today. Now, again, we had other earnings. Bank of America reported earnings. They're not bad earnings on Bank of America, Morgan Stanley, or Wells Fargo. Bank of America right now up 9 cents on the day. A little bit of an up move. That's the daily chart. I'm going to go to the intraday. You can see, again, it had a big rise early, hard sell, big rise, hard sell. Now it's kind of making actually an in spirit of bear flag pattern here in the afternoon session. Morgan Stanley down on earnings as they disappointed on earnings, down about 40 cents. Not a major drop on Morgan Stanley. And of course, Wells Fargo was the last big one to talk about today, and that's basically down 18 cents. They came in line, approximately in line with earnings. Nothing great, nothing horrible. And again, the stock is basically flat to slightly negative when the market is getting hammered today. Now, a couple other things to go over. Let's go back to the SPY. The biggest thing I talked to my premium subscribers about yesterday in the Research Center nightly video, which again was I think 50 minutes long last night. I gave them all the world there in technicals, talking about all the different facets of the market to be on the right side of the trade. And one thing I pointed out to them was the 60-minute chart, because it was that fascinating. What I said to them yesterday was, guys, there's clear as a bell a channel here. You can see up right here to the upper range of the channel here, down, up, down, and up. And we ended right at the upper range, which is technically resistance. Now, I pointed to the fact that 75% odds that this comes down off of yesterday's close. Why? Because a channel that's going sideways, you have to look and refer to the daily chart. So you look to the daily chart. And as you can see on the daily chart, this market's at 52-week highs. When you're at 52-week highs of any chart that has a sideways channel, the odds are 75% chance that that will fail and go to the downside. Sure enough, you go back to the 60-minute chart and look at the fall today. A dead-on call there for a market to move down. In addition, what I also continue to refer to is that I called a top right here on the 11th of January, and so far you have double-topped, triple-topped, and never broken out. And based on the calculations that we've done in the short term, meaning over the next week or so, this looks to continue to be the top in this market, and it so far has held up beautifully. Now, the key is, again, understanding the amateurs. All right, amateurs, guys, are the guys that pro traders, chief market strategists, Goldman Sachs, Morgan Stanley trading desk, they're the ones we prey on, folks. We prey on those amateurs. Now, why do I bring this up again? Because it's an extremely important point. You have all the amateurs when it goes back up. Now, look at the charts here. You've had a big drop here, and then you just reversed it within a day or two and went back to the highs. Big drop again, and in one day you reversed that whole move. The amateurs are the ones that cannot stay and hold their emotions in check. And again, this is going back to the psychology of the markets, folks. The psychology of the markets dictate that the amateurs are the ones that are going to sell at the lows and buy at the highs. So again, anyone short here in this range as you're falling, and then you get reversed on, the amateurs are going to be the ones that say, oh, this market's going higher. It's just not getting taken down. Well, guess who's doing this market activity? Who's the one pushing it up? The institutions. Why? Because they know the amateurs can't hold up and can't wait until they get out of their short positions, and as soon as they take out of their shorts, selling and letting the kind of institutions accumulate the shorts that they're dumping, guess who's coming out here to play games? All right, institutions dumping the market right back down. So my point again, folks, is you have to learn to control your emotions. All right, I can't tell you how many little guys out there, amateurs out there, again, get whipsawed by this activity, and you have to follow the technicals. The technicals never broke the triple top. In fact, yesterday's high in the market was 1 penny. This is the high yesterday. 1 penny within the 52-week high. Do you think it's a coincidence that they never took out the high yesterday? Absolutely not, folks. It was a dead-on signal. I talked to it and gave you guys that. Those of you in the chat room know I spent about 5 minutes in the end of the day looking at that to see if they would do it, to highlight it. And they sure enough came within 1 penny, but never took out the high or touched the high on the SPY yesterday. That was a signal that they were going to drop this market, the institutional money. Sure enough, volume has surged today. Again, we've already done more volume today than we did all of yesterday, and it's not even a quarter past 2 right now, 2 p.m. Eastern time, right in that 2:30 time frame, 2:15 time frame. Have to pay attention to the signals. Don't be an amateur. Don't be a beginner. Learn to control your emotions. Learn to read the technicals, and you will be on the right side of the trade, not the wrong side of the trade. So there's a little educational lesson on psychology for you, and a good example of how many amateurs got whipped out in this trade yesterday when it went up here, yet the pros were just waiting patiently, shorting right up here at the close, saying, oh, we know what's going to happen here, and they're now reaping the rewards. Don't let the Goldman Sachses, don't let the pros take your money from you, folks. That's the bottom line. Now, again, what happened was we fell all the way down, right down to this 113.20 to 113 level. At that point, we alerted the chat room for our premium subscribers that you're at the low end of the channel now. You know there's support. Just like we knew there was resistance up here, and look at the falls you got, you know that there's support right here. All right, right now, we had called out at that point when we pierced, went down to 113.15, 113 even number. The long play, the market has bounced back as much as 50+ cents off that low for a beautiful intraday play. And again, just know the charts. That's all you're doing here, folks, is just analyzing the charts. It does not take a genius. I can't stress that enough. It takes an emotional discipline. You have to control those disciplines, those emotions, control them. You'll be on the right side of the trade. All right, folks, so that's just a little insight into how you have to be. If you're going to become a pro, if you're going to be a consistent moneymaker in this game, you have to understand and control those emotions. All right, looking at this market, let's go back to the intraday. You can see we're continuing to consolidate here on an intraday basis. Right now, what this would be considered an in-spirit of bullish pattern as you kind of float sideways to lower off of this up move. You're now above the 20 moving average. You're still in the lower range of the day off the double bottom. Here's that 113.20 area down here where we went long, and you can see that beautiful long play paying off pretty much all afternoon. Volume again lightening up. That also tells you that you have a general idea that the market's going to go sideways to up off of those levels once the volume died down, which was in the first hour of trading. All right, going to a couple charts out there. What's getting hit today? What are the keys getting hit? Apple Computer, which had a huge update yesterday, is down about $4.50 today. Google is down about $9. Research in Motion down $1.50. Amazon down $1.85. Here's Amazon's chart. You can see Amazon actually making a small intraday in spirit of bullish pattern as well. So across the board, you're just seeing good selling. Again, a lot of selling coming in. IBM, a big catalyst today, down over $4. That's easily a good 40 points probably on the Dow itself on the downside, just a result of IBM's earnings. Remember, tomorrow, Goldman Sachs earnings. After the bell, Google's earnings tomorrow. It's going to be just increasing in volatility here. It's been a fantastic swing trading environment in the market. We've talked about that, giving hot charts and alerts, which is part of the Research Center, to all our members, and even more. So watch that stuff, folks. Be on the right side of the trade. We'll be back tomorrow with a new video. Take care.